Good morning. Curtis Chandler here, President of PFL, bringing you last week's North American Rail energy and macro update. Let's break down what's driving the conversation. We got a lot to cover this week, from a major policy shift at the EPA to a blockbuster deal in the Canadian oil patch. So let's get right to it. First, a quick look at the markets. It was a mixed bag for stocks. The Dow was up 685 points, the S&P was up 17 points, and the Nasdaq closed down 126 points, and that was all week over week. In the energy space, crude oil posted modest gains, with WTI closing out the week at $63.66 a barrel. Looking at the latest EEI report, crude oil inventories fell by 6 million barrels. Crude inventories are 6% below the 5-year average for this time of year. Gasoline inventories also saw a drop, while distillates and propane inventories saw builds. Now, let's talk rail traffic. North American rail volumes were down 1.7% compared to the same week last year. It was a mixed bag across commodities, with coal showing the biggest increase, up 8%, while forest products saw the largest decline and was down 15%. All right, now for the big stories we're watching out for you. First up, a big announcement from the EPA on Friday. The EPA finally acted on a massive backlog of 175 small refinery exemption petitions. In simple terms, these exemptions allow for smaller refineries to bypass certain requirements for blending biofuels like ethanol into the gasoline. The EPA granted full or partial exemptions for 140 of those petitions. So what does this mean? The market for renewable fuel credits, or RINs, went wild on Friday of last week. These 6 ethanol RINs, which started the year around 62 cents, briefly shot up to over $1.20 after announcement, before settling at $1.08 per RIN. It was the same volatile story for D4 RINs. This is a big deal. Higher RIN prices are great for farmers and biofuel producers, which in turn is good for rail demand, as more grain, ethanol, biodiesel, and feedstock for renewable diesel facility needs to be moved. For refiners, it means higher costs. We're also seeing this impact long-term strategy, with refiners like Valero and Phillips repurposing California facilities into renewable diesel refineries. They just don't have to contend with RINs in California, but there are other state initiatives, and some might call them penalties, from a refiner perspective in California, for that matter, the whole West Coast. This is a complex story with major implications for rail. We are watching this very closely. Now let's turn our attention north to Canada, where there are several key developments. First, there's continued scrutiny of Prime Minister Mark Carney's government, particularly regarding its energy and trade policies. Last week, shareholder activists targeted Enbridge and Cenovus with greenwashing allegations, while at the same time the government announces rolling back some retaliatory tariffs against the U.S. to smooth the waters just ahead of the 2006 free trade agreement. The bottom line: the climate is uncertain for Canadian resource producers and manufacturers. The other major piece of news out of Canada is that Nova Energy is requiring MEG in a deal valued at 8 billion Canadian dollars. This move creates an absolute giant in the oil sands, which production expected to approach 900,000 barrels per day. What does that mean for rail? A larger consolidated Cenovus will have significantly more negotiating power with railways. It also will look to optimize its overall supply chain. And most importantly, as a combined company boosts production, those extra barrels will need a path to market, increasing the undergoing demand for all transportation, including rail. Finally, we're watching investment trends across the industry. CN announced a massive 3.4 billion Canadian dollar capital spending plan for 2026. 2025. Focusing heavily on improving track, bridges, and terminals, this focus on infrastructure is a theme across Class 1s. However, new railcar orders remain weak, with manufacturers squeezed by rising steel prices. The bright spot continues to be the leasing market, where fleet utilization remains high, around 96%, supporting strong lease rates. That's a snapshot of what's moving the market. For the latest in updates on equipment for sale and lease or customized rail solutions, contact us here at PFL. Remember, we clean, flare, service, and store cars across North America. Please make sure you read today's rail report. It's a big one. We have 21 charts and graphs in today's report for your viewing pleasure. Thanks for tuning in, and we will see you next week. And read that report and have a safe week, folks.